Hey everybody, it's Dr. Joe here on this Wednesday evening. Hope you're doing well wherever you are, and another great session lined up. And I thought I'll do something a little different today, which is to kind of go back a step back into some of the fundamentals, some of the basics of real estate investing. Sometimes people think I'm kind of going too much in detail, and so I thought I'll step back today and just kind of go through some of the fundamentals. And so what I've called today's session is Introduction to Real Estate Investing, what you need to know, and and what will help you as you start or transition your journey to real estate investing as a real estate investor, which hopefully the goal is to get financial independence and so forth. So that's what we're going to talk about today. Just a couple of little nice announcements. It's going to be the next busy week for the next week or two for me anyway. I'm going to Boston on this weekend for a little break, and then off to Atlanta next Friday. I think I'm going to be a guest speaker at a conference in Atlanta, Own It, Live It. And so it's at the Intercontinental Hotel in Buckhead in Atlanta. So if you're in the Atlantic area, and feel free to let me know, and hopefully I'll be able to see you. I'll be staying at the Intercontinental Hotel in Buckhead, and that's where the event's going to be, and so on. So anyway, that's going to be next weekend. I think it's the 1st, 2nd, and 3rd of November, Friday, Saturday, and Sunday. I'll be speaking on the 2nd day, which is November the 2nd. So check me out if you're in the Atlanta area. I'd definitely like to see you. And shoot me an email, shoot me a social media post, and maybe we can connect while I'm down there. Okay, so today, basics, introduction to real estate investing. And so I suppose the question becomes, well, before we get to that, as usual, if you got some questions, please put them in the chat box and I'll get to them in about 20, 30 minutes or so. So anything to do with real estate investing, any problems, issues, challenges that you have, please send it over and I'll do the best that I can to help you out and answer the questions. And if you want to go into a bit more detail and do a deep dive with me, you can always book a one-on-one. Go to my website, joeasimo.com, www.joeasimo.com, where you can book an hour with me, where we can really, really go deep on any topic pertaining to real estate, any challenges, problems, issues that you're facing. You feel that you can benefit from my 35 years plus experience, please book a session with me there. And so let's get down to it. So I suppose the question is going to be, what are the essential building blocks of real estate investing that all investors, I say all investors, must master on their journey to become financial independence through real estate? Real estate is not easy. It's definitely doable. It's one of the the asset classes, or vehicles that you can use to build wealth. So definitely worthwhile. Anyway, so real estate investing, in my opinion, offers unparalleled opportunities to create wealth. But the path to success, isn't always straightforward. It's not easy. I've learned the hard way through trials and tribulations. A lot of, anyway, a lot of good and bad has happened to me. And so really my take is that investors must develop a deeper understanding of the fundamentals, that drive long-term profitability. Long-term, I'm talking long-term. I'm into long-term, for real estate. It's not a short-term. I'm not really into flips and quick cash strategies. I'm more into long-term and leveraging the power of real estate, both in terms of equity buildup, tax benefits, cash flow, appreciation, and things like that. So these fundamentals, in my opinion, include things like market research, mastery market research. You have to know where you want to buy. You got to know things like property valuation. Make sure that you're not overpaying for something. Financing, the seller, for the most part, wants money. So you're going to have to get money from somewhere. If you don't have it, you're going to need to borrow it from somewhere, whether it be a financial institution, private money, friends, family, whatever. So financing obviously is a key part of this thing. And also risk management. You want to mitigate risk. You want to reduce risk. You don't want to become exposed and hopefully, well, not hopefully, but avoid, losing your shirts or blouses, I suppose. And so whether you're starting out looking to scale Grasping these fundamentals or foundational elements, in my opinion, ensures that your investment strategy is really built on a solid base, a solid foundation, enabling you to make informed decisions and hopefully make the right decisions as you go on your journey. So the goal of this live stream today is to guide investors, whether it's new, seasoned, or intermediate investors, through some of the core concepts of real estate investing, and illustrating proven strategies that I've incorporated on my journey, and that's led me to where I am today. Financial freedom through real estate investing. So by learning from the experience of others, myself, avoiding the common mistakes that we all make, you can unlock the potential for long-term growth, financial independence, and hopefully a thriving portfolio. We're going to, as usual, I'm going to break it down to 6 parts today. So part 1 is going to be why market research is crucial. Market research is obviously designed to give you knowledge as to where to buy or where to invest and why you're investing. So I suppose the question would be, how does understanding the market affect your investment success? How does understanding the market affect your success as a real estate investor? So market research is in my opinion, one of the most critical aspects or components of real estate investing. Understanding where and when to invest can make a huge difference between success and failure. Successful investors, for the most part, conduct thorough research on things like market trends, housing demand, rental rates, and future growth potential. So again, you need to be knowledgeable or versed in where to invest, and some of the things that to consider in terms of where to invest are things like, what's the trend, what's the market trends where you are, what are the housing demand, is there a growing demand for housing where you are, or is it declining? That's going to impact you. Rental rates, if you're going to rent, you want to know what the rental rates are they increasing or are they going down? And also, what are the future growth projections for the area that you're in? Is it a declining market? Is it an increasing market? What's the demand supply ratios and things like that? You want to do more than just buy in quote hot markets. Good times, or as the saying goes, all good things come to an end. So just because you invest in a quote hot market, that's not enough. It may not be sustainable. In a year or two, 6 months from now, a few months from now, it could get cold, which means that you may have bought at the peak and now you're stuck holding the bag. If you, for those people who've been around for a while, if you recall the heyday of 2008, when we had the market correction, a lot of people got in at the tail end of that. They bought at the market peaks, and for a few years after that, the market tanked, and a lot of people went out of business. They filed bankruptcy. They lost their shirts. They lost all their money, and so on. So just buying a hot market is not enough. You need to be in a sustainable market, a market where the demand is there, and hopefully your investment will increase in value over time. So, speculation is not really what I'm suggesting. Speculative purchases in overheated markets is definitely not a good thing, because you could end up losing. And so today, seasoned investors need to analyze things like job growth, population trends, and what's going on in your local area, infrastructure, what's coming in, what's going out, are businesses moving in, or businesses moving out? And because they will have an effect on property values, and whether your market will appreciate in value over time. So, local knowledge obviously is important. We're getting down to the weeds a little bit. So local knowledge about what's really going on in your area, your micro level, things like zoning, things like new business developments, things like, our new companies coming in. That knowing these things can help you with a competitive edge. So mastering market research also means understanding the different types of properties that perform well in different markets. What works in one city, what works in Washington, D.C. may not work in Atlanta, may not work in Phoenix, Arizona, may not work in San Francisco and so forth. But then again, so what's working in San Francisco may not work in Washington, D.C. and vice versa. So knowing what's going on in your local area, taking the time to develop relationships with key people like real estate agents, property managers, appraisers, those kind of people, they can give you an idea. And also going to RIA meetings, Real Estate Investment Association meetings, where you are, you can get a pulse for what's going on locally in your market, and therefore that will help you decide how and what to invest in. Okay, so market, understanding the market locally is very, very important. So, what are some of the action items you may want to consider as it pertains to this? Use online tools like Redfin, Zillow, Realtor.com. To research property values and market trends in your desired area. Study local employment patterns, infrastructure, and population growth to identify promising markets. And network with local agents, investors, appraisers, property managers to gain insider knowledge on the market shifts and opportunities in the local area that you're interested in. Okay, so that's number one, the importance of the market research. Let's go to number two, which is the importance of property valuation. The importance of property valuation. You obviously, it's important to know how much stuff costs where you are, and therefore the issue is, how do you ensure you're not paying you're paying the right price for a particular property? How do you know that you're doing that? And that's all about market valuation. So property valuation is really the heart of real estate transactions. You've got to know what stuff costs, because paying too much for a property will negatively impact your returns. While underestimating a property value or potential value can cause you to miss out on profitable opportunities because you're going to pay too less. You don't want to overpay. However, this is something which is interesting. I recall many years ago, I didn't buy a house. It was like 120. It was 126,000. I offered 126,000 for this house, and the seller says no. No, sorry, I offered 120,000. The seller wanted 126. So we were haggling over $6,000, and I decided not to buy the house. Fast forward 20 years, and that house is now worth almost $2 million here in Washington, D.C. So the point is that if I had paid 126,000, 6,000 more than what I was offering at the time, quote unquote, I quote unquote overpaid, or I would have overpaid. But over the long haul, it's really meaningless. It really doesn't matter if you're in an appreciation market. So be careful about if you take a long-term view, sort of, just be careful. I'm not saying you should overpay, but many years ahead, you'll be kicking yourself that you missed out on an opportunity because of a couple of $1,000s that you're haggling about. Anyway, so proper valuation involves comparing similar properties, known as what we call comps, in the area that you're considering investing in, and consider such things as square footage, amenities, location. They all factor into the evaluation of that property. And also the property type. Is it a single family? Is it a row? Is it commercial? And is it multifamily? That has also an impact as well. So for rental properties, this is mainly 4 or more units. In terms of value, is based usually on what we call the income approach. So you value the property based on how much potential income it's likely to generate. That's the strategy they use for a lot of multifamily, 5 units or more, I think. And technically, it's considered commercial. So that's the income approach that to determine value. For single families, they tend to use the sales comparison approach, okay, which is often employed for residential properties. And so it's based on comparables of similar properties in the area. And for commercial, investors, sometimes they use a cost approach. There's different ways to value, a commercial property, and so on. So the point is that depending on your asset class, there's different ways to determine valuations. And obviously, if you're going to do a rehab and you're going to renovate the house, the goal is that you are buying it under value, and you're going to make some improvements to bring it up to value, and so on. So you will obviously need to factor in the cost of the renovations itself to determine what's the value, what's the price that you should pay. So successful investors, obviously, they have a margin of safety into their deals, such that if things go wrong, if they overpay or they run into problems, they still it's not going to wipe them out. So what are some of the action items associated with the important evaluation? Things like use property valuation tools to compare similar properties and to ensure you're paying a fair price. Conduct thorough inspections to factor in any renovations or repair costs that you're making, and also use the income approach or for rentals, and also use the valuation or comparable approach for single families. Number 3 is financing. So far we've talked about market research. We've also talked about valuation, and we're going to now talk about financing. Obviously, the question becomes, what financing strategies can help you expand your full portfolio while maintaining cash flow? You do need money. A seller wants money, and so money has to come from somewhere. As I mentioned earlier on, it could come from the seller. It could come from the seller financing. It could come from a bank. It could come from another financial institution. It could also come from private individuals. So understanding the different financing options available is really crucial to the successful real estate investor. There are different forms, like traditional bank loans. There are private money loans. There are private money lenders, and there's also hard money lenders. Each of these people or institutions offer unique advantages and challenges, really, depending on your financial situation and your ultimate investment strategy. There are pros and cons with each. So, for example, the traditional bank loans, the ones from big box banks or local banks, they come with typically are lower interest rates. They also require stricter qualification, standards, and things like higher credit and also income verification. And typically, they want a bit more in terms of reserves. On the other hand, private lenders or hard money lenders, they can offer flexibility. They can sometimes close fast. You can negotiate terms and conditions, but you're going to typically pay a little bit more in terms of the interest rates compared to banks. So one popular strategy is the BRRRR strategy, which is what I do: the buy, rehab, rent, and refinance and repeat. That method allows investors to quickly, it's almost, you can scale your business. You can scale your property acquisitions by recycling the capital that you have over numerous properties. And that's what I've done, is that I've used over time, one house to allow me to buy another house, refinance based on the appreciation or the increased value, and then pull some cash out and then buy another one and buy another one and buy another one, etc. So successful investors, can leverage that strategy. And, another strategy is seller financing. This involves where the seller is acting as the bank or the lender, providing terms and conditions, to allow you to purchase the home. That's a strategy a lot of people use as well. So essentially, the important thing is that you have to make sure you have liquidity, you have some money saved up, and having the funds available for a rainy day. So a good rule of thumb is to have some cash reserves for unexpected repairs, vacancies, and also financial challenges that may come about. So you want to have some reserves, as a real estate investor, such that if something happens unforeseen, you can still weather the storm. So what are some of the action items associated with, financing? Things like research and compare different loan products. including traditional banks, hard money, private financing. Explore creative financing options like seller financing or lease to own agreements to increase your portfolio, and also keep a reserve to handle unexpected costs and to avoid over leveraging. Okay, make a move along this kind of midpoint, about 10-15 minutes to go. So if you got some questions, please put them in the chat box and I'll get to them in a few minutes, about 10 minutes. And anything to do with real estate investing, any challenges or difficulties, or just general questions you have, please put them in the chat box. And that's that one. And likewise, if you want to book a one-on-one with me, feel free to go to my website, joeasamoah.com, www.joeasamoah.com, where you can schedule a one-on-one where we can do a deep dive into any particular issues, challenges, and problems that you're facing pertaining to real estate investing. So let's go to number 4, risk management and mitigation. Risk management and mitigation. So obviously risk is, real estate is always risk. And what you want to do is to manage that risk and hopefully mitigate, i.e. have, avoid, if possible, unnecessary risks. So how can you safeguard your investment against potential risk? How can you, as a new investor, seasoned investor, mitigate or safeguard your investments against potential risk? Well, all investments carry risks, and real estate obviously is no exception. And from an economic, there are different risk factors, obviously. Economic downturns is a risk. Property damage caused by tenants, that's a risk. Whatever it is, run out of money, that's a risk. The economy going south, that's a risk. There's lots of things that you can do to manage and mitigate that risk, because if you don't do that, it could really jeopardize your ability to survive the long term. So one key aspect of risk management is having the proper insurance. Insurance, there are lots of different types of issues. There's floods, there's hurricanes, there's, rain, there's wind, there's tenant burn the house down, there's fire, there's theft, there's liability. I mean, there's a lot of things that can happen that insurance is designed to help you in the event that occurs. So having the right insurance policies in place is really, really important. Many investors have landlord policies, liability policies. They have things called umbrella policies, again, to mitigate risk. And depending on where you are in the country, insurance can be reasonable or very, very expensive, and so on. So obviously, I have landlord policies in all my properties, and I also have umbrella policy, which is kind of overrides, or it's an umbrella. It sort of goes over all of those policies. And other things you can do to mitigate risk is I just put down here proper maintenance. If you maintain your property regularly, you do some deferred maintenance, but just don't let it deteriorate and go down, then you could mitigate some of the risks that's associated with owning real estate. It's an asset; it does deteriorate, and but if you can take care of things early, then you can avoid them becoming major problems later on down the line and becoming very, very costly. So proactively maintaining your property reduces the likelihood of costly repairs and helps maintain tenant satisfaction. Tenants like it when you fix things when something goes wrong. And if you do that, you tend to have better customer satisfaction, and you can have lower turnover rates. So tenant screening is also another important part of mitigating risk. By carefully verifying and vetting tenants, I suppose, you can reduce a lot of the exposure you have. Most of the problems as a landlord you're going to face are tenant related, as opposed to property related. So it's really important to vet your tenants. Check things like credit history, employment status, make sure they're working, rental history, and I do a lot of Section 8. And so certain things that you do there, I go to people's houses. But the whole idea is to avoid costly, tenant issues, and to hopefully avoid costly things like evictions, and also to help, hopefully anyway, the tenants pay you on time. So diversifying your portfolio is another risk mitigation strategy. So some people buy in different markets. I don't. I particularly focus on one market, which is the Washington, D.C. area. But some people mitigate their risk by investing in multiple markets. And so that way, if something happens in one market, they're still doing okay in other markets as well. Different property types is another way that some people do to mitigate risk. So they may invest in multiple asset types, whether it be commercial, residential, multifamily, and things like that. So the bottom line is that there is risk associated with real estate investing. Your job, your challenge is to understand what those risks are and to put things in place to reduce or minimize or mitigate some of those risks. So what are some of the action items you can do? As it pertains to risk management and mitigation, things like investing in obviously comprehensive insurance policies, including things like landlord losses, rent losses, tenant damage, and natural disasters, and so on. Create a regular maintenance schedule to ensure that your property remain in good condition. And then also you want to diversify your portfolio to spread risk across different property types and also different locations. Number 5, I've got one more after this. Is tenant management and retention. Obviously, at the end of the day, if you're going to rent property, you're going to have to deal with tenant management and retention. So what are the best practices for managing tenants and ensuring long-term retention? As you know me, I'm all big on this one. My longest tenant now is 27 years, and I have 20-year tenants, 18-year tenants, 15-year tenants, 12-year tenants, and so forth. So what are some of these best practices for managing tenants and ensuring long-term retention of your property? So tenant management is crucial for any real estate investor who's implementing the buy and hold strategy, because tenants are the lifeblood of rental income. If you have tenants, hopefully they'll pay you. If you don't have tenants, you certainly aren't going to get any income. So the key to effective tenant management begins with a thorough tenant screening. Again, I'm going back to screening. Screening is the absolute key. If you don't screen well, you are destined for nightmares, disasters, headaches, whatever you want to call it. So by evaluating the person's, things like criminal background, credit scores, rental history, employment status, you can minimize some of the risk and exposure associated with tenants. I think seasoned investors like myself, we stress the importance of consistent screening to avoid costly mistakes. You have policies in place that you apply across the board for all tenants, whether they are voucher holders or whether they are market renters. So a high turnover rate, because you have that constant turnover of tenants, is very, very expensive. Believe me, it's very expensive. You got to paint the place again. You got to clean the place again. You got no income. You got to start all over again. It wipes out all the cash flow that you've made over a number of years. So things you can do to minimize turnover, things like responding to maintenance requests promptly, ensuring that the property is well maintained, fostering a positive landlord-tenant relationship, and all these things help. I'm into making sure my tenants are happy, and I check in with them every now and then to make sure everything's okay. So many successful landlords offer incentives, to long-term tenants anyway, such as minor property upgrades or rent freezers. And these incentives are designed to keep tenants happy and reduce the likelihood of them leaving and moving somewhere else. Okay, so maintain open lines of communication with your tenants, and make sure you try to address any issues proactively. And if you do that, you stand a good shot anyway, keeping your good tenants for the long term. So what are some of the action items associated with property management or tenant management and retention? Establish a thorough tenant screening process to minimize the risk of late payments and evictions. Offer long-term tenants incentives like minor upgrades or rent freezes to increase retention, and also to respond promptly to tenant concerns and maintenance requests to maintain a positive landlord-tenant relationship. And finally, number 6, scaling your portfolio. We want to grow the portfolio, and hopefully, the question becomes when and how should you scale your real estate portfolio for the long-term growth? When and how should you scale your real estate portfolio for long-term growth? So scaling, in a real estate portfolio is the natural next step. After you bought your first one, you want to go to the second, the third, and so forth. And but obviously, you want to master the fundamentals first. You don't want to start building on a house of sand because it's going to collapse. The foundation is not in place. So expanding too quickly without the proper systems in place can lead to a lot of challenges, and it could drive you out as well. Cash flow issues, and overextended yourself. So successful investors typically scale by leveraging equity from one property or an existing property to fund new acquisitions. We have limited monies, so we have to use the money that we have available wisely. And this strategy allows you to grow your portfolio without using your personal funds or taking on excessive debt. Another key aspect of scaling is outsourcing time-consuming tasks. Depending on you, property management could be a task that you decide you want to give to a property management company. I do it all myself because I found that I can do it quite well. And other things that some people outsource are things like maintenance, bookkeeping, administration, and so on. So by delegating these responsibilities, investors essentially free up time, valuable time, to focus on more important things like finding new opportunities, growing the business, and making strategic decisions. So investing in technology is also, things like property management software, online tools, analysis tools as well. It also can allow you to streamline your operations and will help you to grow your portfolio over time. So expanding into new markets can also be a smart way to scale. That way you don't put all your eggs in one basket in one location. As I said earlier on, I'm okay with that. I like the DC area. I believe in it. It's an appreciating market. So what I do is to grow my portfolio locally, but I watch over my portfolio. Watch it like a hawk, as they say. So diversifying across different geographic areas may be okay. A lot of people do that. That way, they're not sort of limited to one part of the country or one town or whatever it is. It also reduces exposure to local swings, local market swings and downturns, and so on. So carefully, scale your portfolio. Requires financial discipline, but you can do it. I've done it. A lot of people are doing it, and then the issue there becomes how many assets do you want to own or control. Some of the action items associated with this, finally, are things like leverage equity from existing properties to fund new acquisitions without over leveraging, outsource property management and other tasks to free up your time, and explore new markets to diversify your portfolio and reduce geographical risks. So that's essentially it. So in conclusion, real estate investing is a proven path to long-term wealth. But success hinges on understanding and mastering some of the key fundamentals, which we covered today, by conducting thorough market research, accurately valuing properties, understanding common pitfalls, and also to build a resilient portfolio will allow you to reach financial independence. Other things like effective tenant management and scaling strategies also play a vital role in maintaining and growing your portfolio over time. So whether you're just starting out or looking to expand, success in real estate investing hinges on really mastering the fundamentals. And by understanding the market trends, evaluating properties, securing financing, and mitigating risk, investors can over time build a stable and profitable portfolio. Scaling your portfolio strategically and managing tenants effectively are the keys to long-term wealth creation. So whether you're new to investing or looking to grow, applying some of the strategies we talked about today will really ensure that you're on the path to success, financial independence, and leveraging the power of real estate. So my friends, that is it for today. So again, if you got some questions, please put them in the chat box. I'll get to them shortly. And if you want to shoot me an email, you can reach me at joe@joeasimo.com, joe@joeasimo.com. And as always, if you want to book a one-on-one with me, you can go to www.joeasimo.com and book a one-on-one with me. Those sessions have been really, really, really helpful. And I've had some really good feedback from clients that have done that. So you may want to check that out. Let's quickly go to questions and answers, Q&A. Let's have a look. I don't have much time, so 7:37. Let's see if I can answer a few questions. I've got visitors from out of town, so I'm going to have to try and wrap today's session up. Okay, so greetings from Phoenix. Hi, Dao2. Hope you're doing well. And in sunny Phoenix, I'm sure. Hi, Dr. Joe. Have you ever done seller financing? AIN. What's AIN? I'm not sure what that is, but no, I haven't done. Well, I have. Yes, I've done subject twos. That's a form of seller financing. That's when you take over a seller's existing financing, and so you continue the payments. They transfer the title from the seller to you, so you're now the legal owner. The financing stays in place, and then you negotiate with the seller how much you want for their equity, if they have equity in the property. So if a client has, or a seller has, let's say $50,000 worth of equity, you may be able to, take over the payments, give them something so they can move on with their life, and then you continue to take over and pay them the mortgage. I've done that several times. It does require, I think, integrity, because you are taking over somebody else's payments, and their loan is still in place. So if you skip and don't pay, it's going to affect their credit. So be real careful if you're going to do subject to and other forms of seller financing, that you're going to do the right thing and do what you say you're going to do. Otherwise, you're going to cause problems for all parties. Hi, Dr. Joe. Have you ever done seller financing? Did you face any challenges as a seller or the person buying? I think that's a question for, again, if you got some questions, please put in the chat box. I'll get to you. Yeah, as I said before, I've done subject to. That's a form of seller financing. I haven't done a direct seller finance where, the seller essentially is funding my transaction. I haven't done that. I've got private investors who borrow me money, and then I obviously go out there and invest, buy properties, and give them a return on their money. But I've done subject to, which is a form of seller financing, and maybe I'll have a session just on seller financing, because that's a topic which I think is worthy of further discussion. I don't think I've done a session on seller financing, or creative financing, as they say. It's a good idea, Ty. I may do that. Again, if you got some questions, please put in the chat box. For those people in the Atlanta area, I will be going to, I'll be a speaker at the conference, Own It, Live It, in Atlanta, November the 1st, 2nd, and 3rd, which is next Friday, Saturday, and Sunday. I'll be going to Atlanta. It's at the Intercontinental Hotel in Buckhead in Atlanta. Buckhead, I suppose it's supposed to be a nice area, nice part of Atlanta. I don't really know Atlanta very well. I've been there. I used to work there when I used to work for IBM, but I haven't been there for a while. So I'm looking forward to going to that and spend. It's supposed to be a nice place, Atlanta. I enjoyed it when I used to go there. I haven't been there for a few years, so I'm looking forward to going there. If you're in the Atlanta area, if you know anyone in the Atlanta area, let me know. Maybe I can reach out to them and touch base, hang out while I'm in for the weekend. This weekend, I'm going to Boston, Massachusetts, for a family gathering, and leaving out Friday and coming back on Monday. So it's a long weekend in Boston, Massachusetts. Okay, what do we have next? Hi, Dr. Joe. Katie. Hey, Katie. You mentioned that you do drop in visits to the current home of potential tenants. Is this something you incorporate with every solid screening? Yes. As part of my process, I require a home visit. I go to the person's home, and the reason why I go to their home is because in my opinion, how their house is today is how your house will be in 3 months, guaranteed. You can't tell how your house is going to be based on someone's how they dress, what kind of car they got, what's their credit score. You know, it's got nothing to do with it. And so what I found, the best determinant of how your house is going to be is to go see how their house is. You know, and so I incorporate, to answer your question, Katie, I incorporate in-home visits as part of my screening process. You may say, well, why would somebody allow you to go to their home? Well, I have nice homes, and I explain to them that this is part of the process. I apply it across the board to everybody, whether they are market renters or voucher holders. So I have policies, and it's applied to everybody. And so you avoid a lot of this sort of fair housing issues where you only apply it to certain people. But if you apply it across the board to everybody, then you avoid that potential fair housing violations. But yes, I do. And I find them extremely helpful. Typically, it's an appointment. I don't just show up at people's houses. I make an appointment. They know I'm coming. And I usually require that all members of the household are present, because sometimes they try to hide people, especially people, you know, the troublesome person of the family. So I usually require that everyone that's going to live in my house be present at the in-home family gathering or home visit, sorry. And then I go there and they, you know, walk me through the home. You know, and based on that, it's either yeah or nay. In addition to other things, you know, like landlord references, income credit, and so on. But I found that to be a really, really important part of the screening process. A lot of landlords don't do that. What's shocking is one of my tenants recently left, and no landlord called me. It's crazy. They didn't call me to ask for a reference, which means that a lot of landlords are not doing this tenant screening very well at all. And they're using gut feelings. They're using some, you know, I don't know what they're using, but they're not using data, and so on. So screening is really, really key. It's the make or break point of your real estate investing, you know, game plan. And I just got a funny feeling a lot of landlords are just not taking this seriously. And so what I will be doing, I'm going to be doing more of, you know, for those people who want to learn how to do it properly. I'm going to probably have a digital course on screening mastery, screening, and how to do it the right way. And for those people who want me to help them if they got a vacant property, I'll be offering that service as well. I'm doing it right now for Matt in Philadelphia, and also for Shanna in the Cleveland, Ohio area. So if you feel that you need some assistance or help or guidance with tenant screening, that's something that you know, I'll be offering. If you're interested, shoot me an email, shoot me a text, social media post, and I'll do the best I can to see what we can do to help you out. Have you had a situation, this is from Ty, have you had a situation where they hurried up and cleaned when you did the house visit so as not to represent the true look of the house on a daily basis? Yes. I've had people, you go there, you know, first thing that hits you is the smell of pine sol. You know, the place is just reeking with pine sol. You know, you know that they've done a quick clean. But I'm going to say something controversial here. And that is, some people just don't know that their house is dirty. I know it's shocking, but some people don't know. It's just like some people have pets in their homes. They can't smell the pet, and they're almost like immune to it. But somebody coming from the outside can smell it straight away. So same thing here is that some people just don't know their house is dirty. They don't. It looks okay to them. And, you know, you'll be surprised. So yes, I've had people try to cover up the, you know, by doing a quick clean. But you know, my walkthroughs are pretty intrusive, and you can usually, you know, get beyond that. I got some stories to share about that. Maybe I'll do a session just on that. I mean, it's crazy what you see when you go to people's houses. And people who say that, hey, there's no, we don't have any pets on the application, but when you go to the house, you see a whole boatload of pets running around. The house is destroyed by pets, for example, or people just don't take care of their home. It's a mess. I mean, it's just shocking what you sometimes see. But what I found, though, is that the tier one tenants, these are the people that pay their rent on time, no drama, excellent rental history. They're not intimidated by you going to their home. They're proud of their home, and they don't have a problem you coming in there to check it out. So I don't really get that much pushback at all, believe it or not. When I say this is a requirement, if you do it, I think you should do it. Wow, sure smells like Febreze here. It sure does, Katie. And good point. It often takes someone from the outside to recognize that the house is quite messy or smelly. Yeah, it's quite surprising. But again, that's not a judgment on anybody. It's just that if you want to know how your house is going to be, you cannot tell by the credit score. You cannot tell by how they dress, what kind of car they got, how they talk. That's got nothing to do with how the house is going to be. If you want to know, as I said before, do a home visit. And it's just shocking that most landlords don't do that. Katie, again, do you schedule regular visits of your property's tenants, efforts change, etc. throughout the year? Yes. I try for the first year. I know I'm not always able to do this, but the goal is to do it at least once every 3 months for the first 12 months. After a while, you get a good feel for how the person is going to keep the house, and therefore you don't need to do as many inspections. They understand what it is that your requirements are, and so you can kind of cut back if you know that they take care of the property. But I try to shoot for once every 3 months during the first 12 months, and then scale it back to maybe once every 6 months or maybe once a year. Once you have a good idea, this person is going to take care of your home. I just don't have the time to do it as much as I would like to do. So I'm going to be hiring somebody who's going to be helping me do the inspections. And that way it's done properly on a consistent basis. As a sort of home visit checkup. Yeah. So it's not so much a home visit checkup. It's just that, again, it's written into the lease, it's written into the agreement. I say that to the tenants up front. This is what we do. If they're not comfortable with that, it's okay. But we will do a home visit, and we will do inspections of your property once you're in the house, typically once a quarter. Okay, I'm going to wrap it up for today. Hopefully today's session was a good one. Hopefully that's a good questions from Ty, and also from Katie, and also from Dao too, and so on. So again, for everybody else who's in the Atlanta area, I'm going to be in Atlanta November the 1st, 2nd, and 3rd at the conference Own It, Live It, OILI. Check that out. And in Atlanta at the Intercontinental Hotel in Buckhead in Atlanta. So I'll be there. If you're in the Atlanta area, please let me know. Maybe we can connect and grab a bite to eat, just talk shop. It'd be great to see you. So on this weekend, I'm going to be in Boston. So if anyone's in the Boston area, let me know as well. Maybe we can connect while I'm in the Boston area this Saturday. So my friends, I'm going to wrap it up for today. Hopefully you had a good time, and hopefully this was helpful. And I'll see you next weekend. Have a good weekend. Take care. Bye for now.